Great. Now let's continue with the question. So let's prepare the deferred tax account. So we're going to prepare the deferred tax account. So right here, deferred tax. So I write the first year, maybe year 1, year 2, and year 3. Good. So record the opening balance. So the opening balance and record the closing balance here. Now, what's the opening balance at the start of the year 1? The deferred tax. Is there any opening balance? No, there's no opening balance. For the first deferred tax that we have was 200. It's at the end of the year 1. And then the last deferred tax that we have is 100 at what? At the end of year 2. So opening balance for the first year will be dash because there's no deferred tax in the question. Then the closing balance is what? 200 Ghana cedis. So we got it 200. That is it. Still, the network is not strong. Okay, let's manage like that. Now, what's the movement? So record P&L here. That's go to. So opening balance there. What should I do to this that I can get 200? I have to add 200 to it. Good. Then it's a closing balance here becomes open. So your opening balance is 200. Agreed. Now what's the closing balance? The last one was 100. So put it here. That's the closing balance at the end of the year 2. You compare the movements. Then what do you get? When you compare, you get 100 negative. That goes to P&L. You shift this one here as opening balance of 100. Here become dash or 0 at the end of the third year. Then you find the movement. Here becomes 100. And yes, nil. And then you are done. So that's how the account will be prepared. So that is it. So this one goes to the P&L as the deferred tax movement. These ones are non-current or liability. So I will project a question and then I'll ask you to work it out for me. And then you'll be fine. So let's go and then pick some few questions and do justice with it. Great. Now for the year 3, it starts like this. In fact, once you have a closing balance for year 2, it becomes what? Opening balance for year 3. So that's the first case. Second, their closing balance was 0 or dash, so bring dash there. So what should we do to 100 so that we can get 0? Okay, let's subtract the 100. So pick the 100 from it like this. Then here will be 0. How we get it? The closing balance is 0, so that's what we are stating here. This 100 is as a result of what? Balancing, pushing the balance into the next year. Good. And that's it. How it's okay. Great. Okay, now let's try this. Antaka. Okay, now let's look at the question 2 or illustration 2. That's the trial question, and that will be the end of today's section. We will probably continue Monday, the first section, to complete the remaining question. And then I'll forward some questions to you. Question 2. An entity acquired a plant equipment for 1 million January 2000 export. That's a detailed 5% year statement basis. Local tax legislation permit the management to trade asset over a year at 30% a year for tax purposes. So calculate the deferred tax at the end of what? The 30th 31st December 2000 and what? 2014. Good. So let me copy the question and paste it on the platform. So that's the question that we are doing now. So we can try that one. As soon as we are done, then in which we are done. Good. So kindly continue for me. Kindly continue for me. Good. Now let's solve it together. First, the cost of the asset is 1 million. And then the asset is built at the rate of 25% on the straight line. But the local tax legislation permits the management to depreciate the assets at 30% a year for tax purposes. So here we are just asking for the first year. What will be the deferred tax provision for the first year? Assuming the tax rate is what? 30%. Just the first year we are looking for. Even though you can go for 4 years, the asset life 4 years for accounting purposes. For tax purposes, it will be 3 years for tax purposes. Good. Now let's see. So I'll do for the first. Okay, I'm getting some answers here. Good. So 235,000, that's great. Now let's see. So let's go to the board. Let's go to the board. Good. Now when you go to the board, so good. First, year one, accounting base, tax base. Year one, cost of the asset, let's raise it to 1,000. Let's raise it to 1,000. So 1 million cost. Accumulated depreciation will be for the first year 25%, right? So that will be 250, right? Good. And that will give us 750. Tax base, so the cost will be 1,000. Depreciation for tax purposes will be 30% of it. That will give us 300, right? Here will give us 700. So therefore, the deferred tax provision at the end of the year will be a temporal difference of what? This one and this will give us 50. So that's temporal difference. So therefore, and also it's in thousands, that's 50,000, right? And therefore the deferred tax will be, so the deferred tax at the end of the year will be 50,000 times the tax rate of 30%. Agreed. Where the tax rate is 30%, let's go and see it. The question is 30. So the tax rate is 30. And now give us 15,000, right? So it will be equal to 15,000. So that's the first year. That's the first year. Good. Now I'll do for, if I'm supposed to do for 4 years, I'll do for only 2 years for you. Then continue the remaining one. So in a year two, cost of the asset 4,000. Accumulated depreciation will be, it's on straight line or reducing balance. Straight line, good. It's on straight line, then accumulated depreciation will be 500. So it's going for 4 years. So current amount becomes for 500. Good. And the tax base will still be 30% of the written down value. So 30% tax base will be 30% straight line, but it is a reducing value. So down to 1,000, and then a year is 300. So you multiply that out, 2, making 600, right? You have 600. Take it off, you get 400. So therefore, temporal difference of what? 100. Price of this figure, right? So what do you do? So deferred tax will be DT is equal to the 100,000 times what? 30%, and that will give us 30,000. I'll be getting good. So that's the first 2 years. Then you continue to year 3, year 4. Can you continue to year 4 for me? This question is going for 4 years. Just that it just asks you for the first year. The requirement was here. That's all. So this is the requirement. Where the requirement. And then let's go and prepare the deferred tax movement. So deferred tax movement will be to write the deferred tax account. Now if you have deferred tax account here, what is the opening balance? Opening balance will be dashed for the first year, right? But let me do some demarcations here so that we can have like 2 to 3 years. Okay, let me say first year. First, I have to show the first year. So year 1 and year 2. I'm doing only 2 years. All of them will have the currency. So 1, 2, 3. The opening balance is dash for the first year. You can tell me the closing balance. Now the closing balance will be good. Closing balance is 15,000 because it's as at the end, having amount at the end, temporal difference was at the end of the year 1, 15,000. So what's the movement? It was 15,000, the difference. Then we call it here as P&L. And you shift the 15,000 here as well as the opening balance, right? Good. So I record 15,000 here for the next period. Then what's the closing balance? Closing balance is 30,000. The difference is what? 15. That goes to the P&L. Well done. So this is how the movement will be for the deferred tax. So what left is the current, the year 3 and 4, and then the current year tax. We will continue in the subsequent videos. So stay tuned and watch for subsequent videos. Good. So this is how far the rule of the fingers. Thank you very much for coming, for watching. Kindly subscribe if you have not done that, and you'll be fine. Good.